Hello and welcome to the March edition of our U.S. Executive Podcast. I'm Greg Dacko, Chief U.S. Economist, and I'm joined today by Kathy Blasiansek, Chief U.S. Financial Economist. Kathy, the theme here is really the Fed. We saw a major move by the Fed towards a much more dovish stance since the start of the year. What are some of the key elements that we should be thinking about?
Well, I think, first off, the global backdrop is cool. There's no doubt about that, particularly Europe and China as well. So I think that's got the Fed worried, some global cross currents affecting the outlook for the U.S. I mean, so far the U.S. domestic economy looks pretty strong, but as you know, retail sales surprised to the downside in December, quite a bit to the downside. Payroll data for February was also much weaker than expected. So there's some concern. First quarter GDP is lining up to be a bit below 1%. So I think the Fed takes that all into consideration. Inflation's also lagging behind expectations. But I also think there was a bit of miscommunication at the end of last year. So in the December meeting, Chairman Powell came out and I think defended at the time they had two rate hikes as their median forecast. He kind of defended that too much, and he should have talked about the downside risks more, and because it jarred the markets and then set us up for a larger sell-off in the financial markets.
He also talked about the balance sheet normalization process being on autopilot at a time when markets were not digesting that well at all.
That's right. That's right. So it was a series of miscommunications, and now I think what's happened is the bond market is actually turned even more concerned and dovish because of the Fed's reaction, but also because of the data. And we've had a yield curve inversion and concerns, and sort of revived, I guess, some of the concerns about a recession bias, and could we have a self-fulfilling prophecy?
I mean, that's true. I mean, the economic data, as you pointed out, was quite weak around the turn of the year. We have GDP growth that's currently tracking around 1%, which is quite weak in the first quarter. We do foresee a rebound in the second quarter towards 2.5%, but there is still that question. We're still only slowly getting data after the government shutdown, delayed data, and the momentum right now has clearly shifted. We're clearly past an inflection point. There is that risk that people foresee a recession. People don't really like to see switching momentum, don't digest inflection points well. So there is that fear of a recession, which is dangerous. In our opinion, we're not heading into a recession. We're heading into a gradual slowdown of the economy, but that is the big question. And that's what's reflected in large part in the yield curve. We saw the yield curve invert, the spread between the 10-year and the 3-month invert last Friday. From your perspective, does that indicate that a recession is going to happen next month or tomorrow?
No, there's long and variable lags with the yield curve inversion. It could be anywhere from 6 months to 3 years. Actually, the average is about 2 years, so it's a very long period of time. It doesn't mean it's imminent, but nevertheless, it's a signal that we should not dismiss. And even though we're in a low interest rate environment now, we may have brief mild inversions. Those I think we could take with a grain of salt. But if you see a prolonged inversion for some period of time, I think that's a signal the Fed has to pay attention to, and also investors.
Yep, absolutely.
And I think the other thing that plays a part of that is inflation expectations. And I guess, Greg, what do you see as inflation? How's that evolving, as we go through the year?
Well, we're not really seeing much breakout of inflation to the upside. We've been undershooting the Fed's target for a number of years now. If you look at inflation since 2010, it's essentially been hovering around 1.7, 1.8. So really under that 2% target, which is supposed to be symmetric. And I think that's part of the Fed's paradigm shift is this realization that they need to do something to get inflation back to that target if they really want to get to that target. It's not just a U.S. story, by the way. It's a global story. We're seeing yields on German bonds at zero. We're seeing the Japanese yields below zero. So it's a general global story of fairly weak inflation and moderating growth. I think that still will be the case going forward, and that's, I think, largely reflected in the bond market. But you recently wrote a note on whether bond markets knew something that we didn't. We have a lot of clients calling us and asking, what does the Fed know that we don't? Because from our perspective, things are still looking good, but the Fed just suddenly went all dovish. We have even bond markets reacting even more recently. So
That's right.
do bond markets do investors know something that we don't?
Generally, we don't think the Fed nor bond investors have any unique or special data that the rest of us don't have to digest it. But I think what you said, that the bond market's picking up on a few things. One, the Fed turned very dovish very quickly. Two, inflation has been undershooting the target, and inflation expectations going forward have eased a bit. But I do think the bond market's signaling to the Fed they overdid it in the tightening.
Yeah.
That there's a lot of debate whether they should have tightened in December. Although I think we have to be careful. We take a step back, especially as economists. One tightening, on a particular, we have to be careful about calling out just one tightening, one quarter. It's never that precise.
And that's where the communication issue is, right?
Yes.
How much forward guidance was given that they would continue to do so?
I think that's exactly it. I think that's the bigger issue. And then the Fed pivoted. It's a big pivot, in our opinion, and I think the bond market and now is sort of trying to lead the Fed to an ease. I mean, the odds of an ease for this year have gone from 27% to almost 80% by the end of this year, and it's pricing in a full rate cut next year. Now, time will tell. The data will tell. And it also is, I think, very contingent on what is neutral, what's the neutral
absolutely.
Fed funds rate, right? In the near term, the long term, and how the economic data play out. We'll get a lot of data next week, but I guess in terms of neutral, how do you put that in context?
Well, we've revised our Fed rate call to start with, and we believe now the Fed has reached essentially its terminal policy rate for this cycle. So we don't foresee any more rate hikes in 2019. Recall that the Fed's dot plot, the infamous dots, actually point to one more rate hike in 2020. But given the path of the economy, or the expected path of the economy and inflation, we don't really foresee any more rate hikes going forward. It's interesting that you ask about the neutral, because we just wrote a note on the neutral Fed funds rate. We believe the midpoint of the neutral Fed funds rate is centered around 275. That assumes a real federal funds rate around 1% and inflation undershooting that target, inflation below 2%. And so you get that 275 midpoint range, which is quite interesting because it's still one rate hike above where we currently are, which in the sense means that the Fed is still somewhat accommodative relative to that neutral, at least going into the long run, but also signifies that that neutral is much lower than it was 10, 15, 20 years ago, where the neutral rate had a 3 or even at times a 4 handle. But that's going to be a big part of the Fed's comprehensive rethink of its strategy, its tools, and its communication. What can we expect from the Fed in this comprehensive exercise?
Yeah, no, that's exactly right. Well, I think the big thing will be the strategy. I think they're wrestling with the idea of how to deal with inflation undershooting, and for so long of a period of time. This whole cycle, really, it's underperformed, not just the target, but actually lower than what they forecast it would be. And that's important because they seem to not understand, as many of us do, the inflation transmission process anymore. It used to be unemployment rate less than 4%, wages pick up maybe 4%, we're lagging on that, but then there hasn't been that connection between wages and inflation. Inflation has not picked up. So I think they need to review that. Maybe they're going to adopt a new inflation target regime. Maybe it's average inflation rate. But the other thing is it has to be credible, and they have to convince investors and consumers and businesses that they actually can hit a slightly higher target. So for instance, if you've been below 2% for a while, it means you have to be above 2% for some period of time.
Right.
And if you can't hit 2%, how are you going to hit 2.3%? So I think there's a lot at stake here, and it's going to be a difficult road to travel. And then in terms of the tools and communications, I think the tools, Fed funds rate is still the primary tool. But as you mentioned, the neutral rate, where they end, is going to be much lower than in previous cycles. Typically, they ease 5 full percentage points. You don't have that. We're back to quantitative easing, the balance sheet, how they want to use that. We'll be writing about that, exploring it. And then I think the communication is also a big issue for them as well.
I think it's perhaps the most important. We talk a lot about strategy and tools, but knowing how to communicate with your partners, I think, is very important. And we saw the effects of poor communication, what they can have on markets. So ending on that rather
communicating ourselves,
exactly.
right? Hopefully, clearly.
Thank you very much, Kathy, and we'll speak again for next month's executive podcast.
Thank you.